be that message of hope for people out there that are looking for answers. In times of uncertainty, people follow the certain.
Keeping Current Matters' own David Childers. He's going to be covering today some really important aspects of what to expect in today's market. If you don't know who KCM is, Keeping Current Matters, they are one of the leading authorities on all the aspects of the numbers, the economic boiling down of what matters to agents today. And they do a really great job of making it easy to understand and easy to communicate.
Well, thank you for having me on, and thank you for the time you dedicate to do this and help get the message out there no matter what. We're all living in, a kind of a crazy time right now. And so thanks for having me. So let's talk about that. If I were to have to make an analogy right now about, an economic slowdown and going into a recession, the technical definition of a recession is 2 consecutive quarters of negative GDP. But the real, definition of a recession is a slowdown in the economy, an economic slowdown. And what we all know by what's happening out in the world, our economy is slowing down. 2008 was like a tornado came through our town and ripped up, homes and buildings, and ripped up power lines and destroyed things that had to be rebuilt. The equivalent of today is we have a snowstorm that's come into town, and it's shut everything down. It's 6 feet of snow on the ground. But what we know is, even economically speaking, that snow will melt. The snow will let up and it will melt. Historical analysis showed us that pandemics are usually V-shaped, sharp recessions that recover quickly enough to provide little damage to home prices. We've listed here 4 entities, 4 financial institutions that see a dip in the economy here in the first quarter, and that black line represents even. Below it would be negative, above it would be growing and positive. And most of them are saying, hey, we're wrapping up here quarter 1, the first day of quarter 2 as we're on this call, and we're going to see a decline in business in quarter 1. That makes a lot of sense. But what the headline is going to show you is we're going to see a sharp decline in quarter 2. We saw massive unemployment last week, and we're going to see unemployment this week. And a lot of people are being affected by this economy. But what we also know is in the second half of the year, based on how we started the year, and let's talk about our business. The way we started this year, the biggest challenge that we had as an industry is inventory. We didn't have enough homes for sale for the number of people that wanted to buy those homes. But what we saw in January and February were record year-over-year existing home sales, and a lot of that reporting is coming out, but it's dramatically changing. And so this pause in the economy and tailing out here in quarter 1 and certainly in quarter 2, it's going to be a bumpy ride. And these projections, I fully anticipate them to be revised and to be rethought through. Once we get through this, we expect it to be a more of a V-shaped recession and economic slowdown at that. A survey recently by PricewaterhouseCoopers that asked 50 leaders from a cross-section of industries, if this health crisis were to end today, how long would it take for you to get back up to business? And 2 out of 3 of those folks said within 30 days. The other 24% said within 90 days. So really seeing that and understanding from people that are out running businesses, not to say there aren't businesses that are going to be severely impacted by this. Most say, hey, once we get through this, we'll be back to business as usual pretty quickly. And this is a representation of the housing and mortgage crash in 2008. And what you can see here is you see a stock market correction in that time of about 51%. Also during that time, you see home price depreciation through 2007, 8, and 9 to the tune of just under 20%. We all remember that. But when we start to look at 2008, we see a situation that isn't as much like that as it is 9/11. But when we start to do that same comparison of the dot-com crash and 9/11 crash, we see a different picture. And we see then an S&P correction of about 45%, so volatility and loss in the market, but we actually see home price appreciation during that time. And you can see that there on the screen. So to go back to that question, we start to see volatility in the stock market looking much more like 9/11 than 2008, and expect the market would react and respond in a way more similarly to that. What I'm sharing here is prior recessions in this country and its correlation to home prices. So what our research team did was went back and looked at the 5 past recessions in this country and what happened to home prices. So what you can see is in 3 of those 5, home prices actually appreciated. One time in 1991, we saw marginal depreciation, but what everybody remembers is 2008 when we saw massive depreciation. So if we want to know what that looks like, we can go back in history and look at times there have been recession. Again, definition of a recession is an economic slowdown. When we saw that happen, what happened to housing, and be informed in getting that message out. So yes, we can actually we can look at that and draw correlations there. All right, so the first one that I have up here is a comparison of home price appreciation leading up to the crash of 2008 to current home price appreciation. Now, what this is what we would refer to as macro US data, average data from across the US, certainly different at price point in different local market. The 6 years leading up to the crash, we saw, you see it on the left-hand side of the screen, compared to the 6 years today, we see appreciation much less. In fact, the highest year leading up to today is not even equal to the lowest year leading up to 2008. And while, yeah, prices are appreciating and growing, we don't have runaway appreciation in the housing market like we did then. We look at the Mortgage Credit Availability Index. It's a report that comes out every month from the Mortgage Bankers Association. And the way to think about this index is the higher the index, the easier it is to get a loan. You see on the left-hand side how high the index was before the housing bubble. Mm-hmm. Everybody in our business knows there was this pendulum swing and guidelines and qualifications to obtain financing for a home loan. And where we've remained after that is nowhere near where we were prior to the crash. We often used to joke around it was hard not to get a mortgage back then. And today we know it's dramatically different. The number of homes for sale in this country, inventory on the market. And what we know going back is that we had just over 8 months of inventory on the market heading into the crash. And right now, we've got right at 3 months of inventory, probably a little bit less than that as folks are taking their homes off the market, given the current situation. And we started this year with the biggest challenge to our industry being available inventory to sell. And so we know a balanced market at 6 months, below that being a seller's market, above that being a buyer's market. We don't have an oversupply of homes on the market to deteriorate pricing right now. The total amount of equity cashed out by Americans pre-crash and then today. And so think about these as cash out refis. The 3 years leading up to the crash, there were $824 billion as cash out refinances in this country. The 3 years leading up to today, there was $232 billion refinanced as cash out refis. And I'll tell you this, consumers, by and large, this picture shows it, have decided now to treat equity very differently.